When the economic environment becomes uncertain, we provide the truth from a breadth of perspectives to help people make decisions. We not only compile and analyze the data that moves our ever-evolving economy, we carefully craft our own to provide clarity across industries, businesses, and employment markets. We identify unique opportunities to deliver asymmetric returns and focus on capturing value created during periods of higher volatility, transforming the financial landscape together. We're MacroEdge.
Good afternoon, everyone, and welcome to MacroEdge Radio for Friday, January 24th, 2025. This is John Galt speaking, and folks, we have a fantastic show tonight. This is different from what we normally do. We're not departing from the theme. We're departing from crypto. We've had a few weeks of crypto coverage. It's time to sit there and start looking at the big picture. And by the big picture, I mean the macroeconomic picture, equities, and we're going to do a little bit of energy tonight. We have a very special guest. That's Mark Rossano, CEO of C6 Capital Holdings, LLC. We're going to get some different perspectives, and we will dig into that in one moment as the markets are winding down and closing. What we're seeing is some insane, I do mean insane, market action after a week of bullishness. I don't know how to sit there and describe this other than we're seeing a lot of reflexive action and a lot of people beginning to engage in distribution. Volume today looks pretty healthy. We're going to be well over 7 billion shares, but not as healthy as we have been in the past. Dow finishing about down 140, S&P down 1747, NASDAQ down 99.38, dollar index down 57 ticks to 107.78, as of course President Trump wants a weaker dollar and more inflation. The VIX, though, is not validating the move in equities, down to 1485. We're not going to cover the cryptos today. Gold up 1389 to 2778. Silver up 27 cents to 3112. WTI crude, which we will get into in great detail with our guest, flat at 74.62. Brent up 19 cents to 78.48. Copper down 2 cents to 4.31. The big alert on commodities, in my opinion, is two of the major commodities, coffee and cattle. That's steak and Maxwell House for those of you out in the hinterlands, have hit new all-time highs. And your host is in utter, complete, total panic mode. And I do mean utter, complete, total panic mode. And I'm trying to get Mark Rossano to pull up because the X thing is acting squirrely again. There we go. Mark, welcome to MacroEdge Radio. How are you doing, sir? And he can't hear me. This is not a good start. This is how these things happen. We are going to sit there, and hopefully he can hear me in a minute. We've had this problem before with X where it sits there and it skips for a minute. This is not a shock. Mark, are you there?
Yeah, can you hear me?
You're sounding great now, sir. Welcome aboard to MacroEdge Radio, and to all the guests who are sitting there joining in. This is going to be fun because we get to talk macro and some other specialties that your team focuses on. Please give a quick introduction to our audience, talk about your website and what you focus on.
Sure. Well, thanks for having me. We focus on the private equity side. We do energy infrastructure with a focus on power generation as well as fertilizer. So I've spent my career across the commodity space with a big focus in oil and gas, working across 94 different countries, 5 different continents, doing everything and anything that has to do with moving crude, moving refined products, LNG, anything that can help power the world. And right now we are focusing the most on electricity. We think power is a huge opportunity, and there's going to be a lot of shortages as data centers become the focus. You talked about Trump, and he not only does he want inflation, he wants $500 billion to build data centers. I laughed because on what grid? So we're going to see that come to pass. Right now, we've deployed capital, purchasing several hydroelectrics a company called Celtec, which processes sulfur from oil and gas into a micro elemental sulfur solution for the ag space, which is exciting just because there's a big shortage in sulfur in the world on the ag side. But there's more than enough in the oil and gas side, especially as a lot of these wells get more sour and need to process that product or byproduct into something else.
Well, that brings a question up because one of my themes this year, and a lot of people know that I have distinct biases, one, because I'm older, and two, because I'm biased. Natural gas. Everyone seems to be on this nuclear theme, which I understand is going to be the future. However, development in the United States, thanks to the environmentalist whack jobs, takes years. In my opinion, if you're going to develop all these data centers, the cheapest, most reliable energy supply would be pipelines and natural gas in the interim. Is that part of your theory as a company?
Yes, that's absolutely the case. So, I've done a lot in the nuclear side. I've done everything from SMRs to pebble reactors to thorium. And there is a time and a place, to your point, in terms of just where we are in this cycle. I would be the first check writer into a nuclear facility in the U.S., but you need to tell me who's paying me penalties and fees if this isn't operational in under 5 years. So the problem that you have is, how are you building it? Well, who are you building it with? What is the red tape? What is the regulation? So it's going to be very difficult to see any SMR or any nuke get built within the US. I think you have more of an optionality in some of the other areas. But to your point, we're sitting on a sea of natural gas, and it would be an error if we did not take advantage of it. So when you start looking at the natural gas side, and this is something that I made a call on when Biden first became president, was that you have to watch the rhetoric, because on that side, on the environmentalist side, they went right after crude. They really kind of showed or tried to show how dangerous it is and it's so pollutive. And they kept calling natural gas a bridge fuel. And I kept saying, I was like, the rhetoric is going to change and they're going to drop the term bridge fuel. And it's just going to become a fuel of the future, because they're recognizing the importance of baseload capacity. We have taken down coal. We have gotten rid of so much base load that now there's massive distortions in the power grid. There's massive shortfalls where all of these data centers and these other demand centers really can't get their interconnects, because we don't have the power to supply. And the easiest way to rectify that is to turn to natural gas and these longer cycle turbines, instead of relying on peakers, which are only supposed to be operational 10 to 20% of the time. We're now relying on them 40 to 60% of the time. They're very inefficient, and we really have to start being serious about how we're going to power the next evolution of the internet, if you will.
Well, that brings up another question, because in Florida, we haven't discontinued all of our coal plants, but it's going to be a phase out as the pipelines are built here. This brings up a question, though. Most people recognize natural gas powered utilities as a public quote unquote utility. Are the options, or have you seen opportunities for private power generation that is industry specific, such as data centers, with pipelines being built specifically, spider lines, other off main grid lines, for the future? Because I think personally, my theory, and this is just me speaking off the cuff, if you can come up with small power generation dedicated to specific companies, it's an opportunity that's not being exploited.
I 100% agree. So one of the things that I did in the past was in Vietnam. We built a power center that was dedicated specifically to Samsung. So we did it we initially did it with Kia. And then we were looking for some other individuals. And what the idea of it is, you get your single source. So who is your single customer? And this is obviously on a much larger scale. So you get your single customer, And once you sign them on, they'll essentially buy 70% of whatever you produce, whether that's Samsung, a Kia, Hyundai, Panasonic, and then they buy 70%. You have 30% to sell. They're signing on for a PPA or power purchase agreement that'll be 10 plus years. That'll have some sort of escalator against inflation. You have your rate of return, and then you can sell the other 30% at a discount to workers, to other industries or other businesses that'll be around there. You could do that in these rural areas that are being developed. One of the things that we have an opportunity to do here is, to your point, is create almost like a microcosm of that, where instead of being in front of the meter, you can go behind the meter, where you need to build something to spec, because one of the things that the ISOs, which are the independent system operators, are asking people that they have to take their load down. And the independent system operators, that's New England ISO, New York ISO, PJM, SPP, which is Southern Power Pool. These guys, they only care about balancing supply and demand. They don't care about the politics. They don't care about the different states and if they're green or not green. Their goal is to say, you want 1 gigawatt, I'm going to get you 1 gigawatt. So one of the things that they're looking at are how do they try to lessen that load? And to your point, it's trying to go behind meter. So one of the things that the data centers and the power consumers have seen, it is much easier to go next to the generating capacity, because realistically, building transmission lines could take you 15, 20 years. Fiber optics is 70% cheaper and that much easier to use on right-of-ways. So what they want to do is use some of these spider lines, use some of these pipelines that are being built, and see if they can build 100, 200 megawatt facility that can either supplement or cover the full amount of power that's going to be demanded. Now, the issue that you're coming up against is the regulation, which is something that Trump is trying to streamline in order to allow some of these things to be built faster, to allow for the data centers to be built at a faster clip.
Following up on that, with the ISOs, is it not advantageous for the data centers to be developed in those states that are going to be more permissive for these independent power companies to spring up, or independent generating units, and provide? Because in Florida, we greenlighted pipelines, as you're probably aware. We greenlighted pipelines and that they were offered. If you can sit there and provide green lights and accelerate the pipelines for natural gas from Texas, from Louisiana, from wherever, and the permissions and building of said power stations, that's going to make a major change in where data centers were traditionally located, like the West Coast or the Northeast. Am I not correct?
Yeah, there's two levels that have to be looked at. So one of the biggest issues right now is the equipment. So even if you can get it built, it doesn't mean you can get the transmission or the capacity to do it. So one of the running jokes that I have is, if you call GE and say, I want a turbine, a gas turbine, they'll be like, okay, great. Do you want to deliver it in 2028 or 2030? And people are like, wait, what now? I want it now. They'll just laugh at you. So there's a backlog that you're going to have to get in order to get this equipment delivered on site. The other benefit, and one of the things that you pointed to, is you are going to see this change in how the infrastructure is being built. One of the biggest power things that really is underappreciated is the distortion in the grid. And the distortion is like, we're alternating current. So you flip back and forth. We operate on 60 gigahertz. And the problem is, if you have these distortions, you're not getting the full wave. So the transformers are working overtime in order to adjust to these distortions. And we're seeing that where you have a density of data centers, the distortions can go as far out as 500 miles. which is huge if you think about just where the data centers are and how they're being built. So and not to use Silicon Valley and Pied Piper, but it's a similar mindset. What happens is instead of having these mega facilities, we have more micro facilities that are not a gigawatt, but maybe anywhere between even as low as 5 megawatts up to 50 megawatts, and spread them out. And the idea is that you then have an interface that will rank or look at what the query is. Like if you and I are looking to go out to dinner tomorrow and we want to Google our favorite restaurant if they have a reservation, well, that's a query, but that's not something that's going to take intense computing capacity. Where if you wanted to, ask some AI to reconfigure E equals MC squared, and you send over a 50 tab Excel document with your calculations and ask it to review it, that's going to be something that's way more intense and is going to take something that's going to live on a natural language server and take a lot of computing capacity. The idea is to separate them, use them into, okay, this is a simple query. This can go to this facility that is not overly complicated, doesn't have as many servers, and kick it back quicker, but with latency. And they're starting to recognize that you and I Googling something or asking some obnoxious question of, what movies was Sydney Sweeney recently in, we don't care about latency, and realistically, we wouldn't recognize latency. Where some people who can't operate with latency need to see that instantaneous, they're getting smarter on how to do that to try to lessen the load and spread out where these data centers can be.
Well, I think you hit the nail on the head with your theory and what you're proceeding with, and I think the future is exactly that. I can see Google not wanting to become a power generator, but contracting to companies that have the flexibility to provide some public services, because let's face it, the states are going to require that power generation as accessible in case of an emergency. However, if your primary customer is Google, 95% of the time you're providing power to Google or to Elon Musk or whomever. With that in mind, is it not true now we're no longer going to have to worry about where plants are located or primary manufacturing and distribution points, but where we can put power plants in relation to the pipelines and how fast the pipelines can be built? I really believe that the federal government's going to get out of the way finally and allow the pipeline networks to be expanded to where they should be.
I agree with you. The other issue that is going to come into play is, what are you spending your money on? Because if you're somewhere, let's just say you're in, Michigan. A data center can spend more money on the infrastructure and less money on cooling. So if you were to break it up, you could say 60% would be spent on hardware, 20% can be spent on cooling because of the climate. As you go further south, and obviously you have a more problematic summer and what can be a problematic spring and fall, depending on how the weather shakes, you then have to worry more about cooling. And that's also going to weigh in terms of how much of the equipment is available, and is there enough either natural gas to power the cooling centers? Is there enough water to cycle it through? Which is interesting because one of the things that we're looking at there's about 90,000 flood control dams within the U.S. And there's obviously a lot of them along the Mississippi. And we've been asked to look at some of these opportunities where we could provide some supplemental power, where we build the power source on the existing dam, which is owned by the Army Corps of Engineers. We build a powerhouse, and then we can sell that either to an entity that would then use the renewable energy, or we would be able to use that as a base load into the existing grid to provide support and backstop for this increasing load demand. And there's different ways that you can attack that, because not only are you going to be able to go after the natural gas, create something that's going to be operational, let's call it 86 to 91% utilization factor, but this is the Mississippi, especially at the mouth of the Delta. So if I build a powerhouse, I'm going to be operational anywhere between 60 and 80% of the time, which is a huge benefit for something that's going to be, an operational benefit, especially because I'm right next to a water source, and I can actually use that to cool some of these data centers that actually come with some decent acreage that they could then put right on the shore, which is another opportunity.
So, do you see a new network of power generation where not only can the private companies sell a large percentage to a dedicated customer, but also auction off excess power to other states or municipalities in the near future?
So the answer is yes. You can do that right now by quote unquote wheeling power, where you send it into different areas. But now the tech companies have taken it to the next level, and they'll do what's called a virtual PPA. So this could be something where Microsoft has a data center, let's say in Pennsylvania, and Pennsylvania utilizes, based on where they're located, 80% of that power is coming from coal. Well, they can come to people like me or someone else that maybe has nuclear or has hydro, and they can sign a virtual PPA saying that, well, even though I'm actually receiving the power here, I'm actually paying for and supporting the renewable power in a different area, which is acting as a virtual PPA. So I think you're going to start to see more of that start to play out, because we need coal. Coal is not going away. You're seeing more and more of these facilities extend their life, get a reprieve in terms of their shutdown until more natural gas can get built, and until we can really perfect or at least recognize the limitations that are in solar and wind in order to try to balance this. Because one of the things that I've always said when people talk about, oh, we need to go net zero, it's like, okay, well, net zero is a balancing act. Why can't Michigan or West Virginia, which has, access to hydro and coal, well, why can't they have coal in one area, and then that can be offset by solar in Nevada, which then can be offset by will allow you to build more coal in Wyoming, which will be offset by solar in Florida. Like, why do we have to look at it state by state? Why don't we look at it as an aggregate? And if you do it in that way, I think we can create something that's going to take advantage of our geography or topography, as well as the natural resources that the U.S. has been blessed with.
So it sounds like you believe that those power generation companies, especially private entities that are able to adapt to and build bimodal operational systems, in other words, ones that can, or trimodal or whatever, fluctuate between solar, coal, nuclear, and of course, natural gas, are going to be ahead of the curve versus traditional public utilities, which are trapped by the regulatory nightmare in their individual states.
Yes. I think if you accept, and I think we've started to see this, I worked in Masdar City working on short cycle gas turbines, wind, solar, and geothermal, trying to figure out the right balance and mix. And the whole concept was solar works when the sun is shining, wind works when the wind is blowing, and short cycle gas is a fantastic base. And if you work with that balance, you can create something that is reliable, affordable, and renewable. But we tried with geothermal. It happened to not really work at the time. This was years ago. But we, instead of getting away from accepting the limitations, I don't want to say we, but the government, the banks, they ignored the limitations in solar. I mean, this was the first time I was introduced to the fact that, the Shockley Quasar law, the SQ limitation, which, a solar panel cannot go above 34% efficiency ratings without essentially melting. Clay is adhesive, and clay adhesion becomes a huge issue when you think about the efficacy of solar panels over a certain time period based on wind, soil content, and rain. But we got away from that. SPP is your perfect example. So the Southern Power Pool was looking at people's winter factors, and they noticed that people had solar at 13%. And you're like, guys, 13% in the winter is absurd. Assume 1% and be happy if you get 7%. I mean, this is exactly what happened with ERCOT. Everybody assumed that 35 gigawatts of wind was going to be fantastic until they were expecting to have 20 gigawatts operational during Uri, and instead you had 3. So now you're starting to get a bit more of a rationalization, and then if you can start working with that balancing act, I think you can start to see more opportunities in the future.
Well, folks, real quick before I go any further, because let's face it, I'm a geek. I'm geeked out by this conversation. Let's move forward with a quick update. MacroEdge.net/ozone, MacroEdge.net/ozone. Sign up for a 2-week free trial. And don't worry, Mark will promote his website and C6 Capital before this is all over. Mark, I got to ask, let's go to oil. There's been a lot of premature writing off of the viability of oil. Now, right now, there's this giant theory that drill, baby, drill is going to be the future. However, when you say drill, baby, drill, that dilutes the price of oil on a global basis. And I don't think people seem to understand. We just had massive Halliburton layoffs. We've had massive layoffs in the oil industry. You can't force people to drill unless there's a viable demand. And if we're in a recession, which some of us adhere to, is it not wish casting to think that oil is not going to dip down lower before rising higher based on demand?
If there's one thing that Trump is great at, it's sound bites, headlines, and let's be fair, trolling. And one of the things that is a fantastic soundbite is drill, baby, drill. It sounds great. It's catchy. You've heard it before. But to your point, who are you selling to? Where is your incremental barrel going? So not to get too nerdy about this, and if I go too down the rabbit hole, please pull me out. One of the things that our refiners, which were built in this, realistically, the last one coming on in 1978, we were built to run heavy sour. We were built to take Mayan crude, Venezuelan crude, California, tar, Saudi, Iranian heavy, things that were cheap. And we would process it, but you process it a specific way where you have coking capacity. So essentially, you break it down by cooking it. But you start with way more hydrocarbons the heavier you go because you have a lower API. Now, the problem is, as we have discovered, or I should say rediscovered the Permian with shale and fracking, the problem is our refiners are built to be between 32 and 34 API. We're producing shale at 42 to 48 API, which means that, every refiner that could has maxed out the amount of light sweet crude they can run through that system. They've built additional pieces to their refiners, whether it be alkylation units or ISO units or some sort of hydrocracking. They've maxed that out. So now, to your point, every new incremental barrel has to get sold into the international market. Whether or not you accept the U.S. is in a recession, I don't think it's very much of a stretch to believe that Europe is in a recession. Europe is our natural export for light sweet crude because they have simple refining. A lot of them don't have cokers, so they can run a higher lighter cut. But the problem is when you use this lighter crude, it makes more gasoline. So you either make great gasoline, not much diesel, or you make diesel and then terrible or low grade gasoline. So when you look at Europe, they're essentially tapped out with the amount that they can absorb. And then you turn to Asia, and Asia's like, well, on a shipping basis, sometimes the ARB makes sense, sometimes it doesn't, depending on what Saudi Arabia does with their OSPs or official selling price. So there's really nowhere for our additional crude to go. So why would you knowingly essentially destroy or push down that international price. So when you look at China, I will die on this hill. I called it in February of 2021. I said that China was structurally broken. And people came after me because it's like, oh, you could have said this since 2011, which was 100% true. Because realistically, was it going to be 10 Go cities? Was it going to be 1 million Go cities? Was it going to be 10 million Go cities? At some point, the law of diminishing returns comes for us all. And that's what happened in China. So now you have a structurally broken real estate sector, a consumer that has taken massive losses on real estate, and it's a naturally saving or oriented populace. They're not looking to spend. They're not looking to do much. So where is your new demand for crude? India was your bright spot, but they've slowed down as their exports have slowed. So realistically, you have this ceiling. My ceiling in Brent is about 77, 78. But then when you start going lower, you still have about 5 million barrels a day off the market based on OPEC plus, based on some other increases where the UAE and some of these others are bringing new capacity online, increasing what their spare capacity is. So you're in this bubble of, let's call it 73 to 78. And I think personally that OPEC is happy at 75 because 75, everyone is kind of comfortable. I feel as though we've gotten used to spending $2.85 a gallon for regular and let's call it $3.30 for diesel. And if we can keep that there, it would make the inflation numbers, quote unquote, look better because on a year over year basis, it looks like they haven't changed.
Well, let's move forward because that brings one more question. Do you see Russia and OPEC trying to draw a line in the sand in the near future?
So I think that Biden, one of the things that we've always talked about is that price caps on crude don't work. You know, I can assure you that my 9-year-old could come up with ways to get around price controls. The easiest way to enforce a price cap is to go after things that you can control, which is insurance on shipping and ships. So one of the things that Biden did at the very end of his presidency was add 136 ships to the sanction list. And India accepted that we're okay with this. We won't accept these ships into our ports. You know, Russia has the ability to still send that into China, but they're losing where they can send this crude into. So I think at this point, Saudi is trying to gain back market share. And they're trying to gain back a certain amount of pricing power. And by sanctioning Russia, it allows them to essentially take away some of their where they were able to send crude, which was India. Because just to go through quick history on India, the Hindis and the Persians have been friends for millennia. So a lot of the Indian refiners were built specifically for Iranian medium. Iranian medium crude is very similar to Russian Urals. So realistically, they can go back and forth. When Iran or the Houthis in Yemen started firing on Indian cargo ships, Indian naval vessels, well, you can assume they didn't really appreciate that. So they then banned their facilities from buying Iran, and they relied heavier on Russian Urals. So, which was fine, but one of the things now is they've seen their demand shrink, so they've accepted the new sanctions, and they've increased their purchasing from the Middle East. When you look at Dubai premiums, when you look at Murbain, but then that has now allowed China to buy some cheaper Russian crude. They continue to buy Venezuelan. They're trying to continue to buy Iranian coming through Malaysia, while they're trying to balance and manage their economy. So realistically, I think Russia is struggling. They don't really have many friends at this point, and I think they are in a good position. Saudi's in a good position to get back some of that market share as Russia struggles to find buyers for their crude.
Well, there's a story that broke on Reuters, and I got to ask you about this. Sogaz, don't even ask me to pronounce the other one, and VSK Insurance have been extended by 5 years to 2030 to allow and ensure Russian vessels calling on the ports in India. I know this is tit for tat, and this is the game that's being played. Do you think with the Trump administration coming in, there might be some backing off on some of these sanctions as they attempt to sit there and resolve the Russia-Ukraine war?
You know, I think there's going to be some backing off because we've done a decent amount of work in Kazakhstan, and when Trump won the presidency, there were Chinese nationals that were in Kazakhstan that were essentially buying European goods, U.S. goods, and Chinese goods in Kazakhstan, and let's just say doing a little bit of a flag switch. So instead of having those flags, it has the Kazakhstan flag and it goes into Russia. Now, Trump made it very clear that if you are doing this and you have an entity and or family in the United States, good luck accessing your accounts. Well, because Trump can be a loose cannon, everybody took him very serious, and that stopped a significant amount of flow out of Central Asia into Russia. So they've already started to feel the squeeze. In my opinion, I think Iran is a much bigger opportunity set because, and I have articles to prove it. I said at the beginning of 2021 that Iran, by the end of this decade, there was going to be a regime change, and that I will be doing business in Iran by 2035. In 1979 revolution in geopolitical terms was not that long ago. Generational cycles are real, and a lot of the people that were supporting it are aging out. And now you have an opportunity to bring in a new change in the area. I think you're starting to see more unity in the GCC between the UAE and Saudi, and understanding that if they can give people opportunities, you can actually essentially let's call it buy peace, because people aren't going to search for answers elsewhere. So I think that there is an opportunity where they can be softer on Russia and really strengthen and tighten down on Iran and see that shift. You know, the Iranians have lost most of their anti-aircraft capabilities with the recent Israeli strike. They are on their heels in terms of what they can actually get. They have not received new S-300s, S-400s, which are the systems that they've been using from Russia because they're tied up elsewhere. So I really think that the Trump administration is going to focus more there, and then that will allow him to carry more favor within OPEC. And because realistically, they want that quote unquote Shia crescent to really fall. Because the Saudis, the UAE quietly got very nervous because, let's be fair, the Shias convinced the Sunnis in Gaza to go essentially rogue and strike the Israelis. So there was a lot of concern of how much influence do they have, and there's been a push to really reverse that.
Well, 100% agree. That's my area of study and expertise to a degree, and I agree with you 100%. I think that there is a revolution coming in the Middle East, and I think that Trump's administration will use their leverage with Russia and India to push against Iran and force change. But let's move to macro, because that's just as much fun for me as it is for you.
Oh, yeah.
I mean, let's face it. I'm one of the people who are in the stagflation camp.
Yep.
And I know that sounds boring as hell to people, but I believe that because the Fed's slow reaction time to inflation and slow reaction to recognize real unemployment expansion, which the MacroEdge team, God bless my team, have recognized and worked on, we're in the midst of a potential cyclical stagflationary cycle. Do you feel the same way, or do you think that we will sit there and see a change after the first half of 2025?
So you're going to laugh. So for those that know me, in 2019, July of 2019, my call was that this was going to be a lost decade. And the reason why I thought this was going to be a lost decade was several-fold. One, in July of 19, as we got into the beginning of 2020, my view was that inflation had really gotten out of control, and they were trying everything they could to kind of move the direction in which you were focusing. But if you just looked at the simplistic nature of it, you could easily see that inflation was running closer to 5%, not their stated 1.9%. So my view as we went into 2020 was that we were coming to the end of the bond bull market. We were going to see rates that were going to move towards what I used in the 10-year, the long-running average of 4.28%. I thought we were going to go right through that and start to press towards 5%. This was going to send the Fed higher because they were going to have to get in front of it. So I thought the Fed funds rate was going to go to over 5%. And you were going to see inflation have a long-running average of something between 4 and 5%. And my view was that that was going to create this stagnating capacity. So I made a call, and I think I named it, this was now after COVID, of in 2021, what happens after COVID? And my view was that you were going to see this because there was so much liquidity dumped into the market rapidly, that just accelerated my view of what was going to happen in the 2020s. But now, because there's a lack of appreciation of the general basics of macroeconomics. Everybody, and I had these debates with these DC politicians where they're like, well, Powell just needs to cut rates because we need rates lower. And I looked at them, I was like, you understand that Powell sets the overnight rate, the market sets the yield curve. And based on the amount you guys are spending, the yield curve is going up. I don't care what Powell does, because it's basic supply demand. You guys are pumping more paper into the market. Every time we have to roll every lick of debt, we then have to increase it to cover the interest expense, and then we have to increase it again to cover the deficit. So not only are we rolling everything that we had, but we're also adding to it. I was like, so every time you're issuing more debt into a market that wants it less and less. So in order to incentivize that, you have to pay a higher interest rate. So if anybody who's sitting here and saying that they need lower rates, my running joke was, it's not the rates that are wrong, it's your hurdle rate. And that, I think, is coming to pass. And because there's so many zombie companies out there, there's still so much froth in the market, it's going to take over a decade to really do that. And unfortunately, and this is where the debate can happen, I think that deflation has a very bad connotation because of the 1930s. And the one thing that I like to highlight is our demographics are very different. We are not going to have 30% unemployment. We physically do not have the demographics to achieve that. If you think about from 1860 straight through to 1930, you had multiple potato blights, you had multiple famines in Europe, and you had a huge shift of populace coming from Europe, the Slavics, the Nordics, over into the US. We don't have that. It's a very different world. So when people panic about deflation, it's like, guys, if we just went back to 2019 numbers, that would be better than what we currently have, instead of trying to hold to this belief that we can inflate ourselves out. But the powers that be want that, and instead you're going to see essentially this move, to your point, of zero growth, or slightly negative, slightly positive, and a very onerous inflation number that is going to be very sticky, because nobody can just come to terms with the fact that we have to pull this excess liquidity out of the market.
That is exactly why I follow the Atlanta Fed sticky CPI, which has a much more realistic historical basis for where inflation. It is an unfortunate consequence, and this leads into a quick question. And please rant as much as I do. You have the table and the audience to listen to it. The government provided data, BLS, BEA, NBER, etc., is so far behind the curve. I think they're still fighting the last war of the GFC. Please offer your opinion on the validity of trusting their data to make financial decisions. especially personal or professional investment decisions?
It's funny because I was going to get a PhD in macroeconomics with a focus on rates and currencies and the interplay between the two. And I was going to look at 1965 to 1985, funny enough, as we currently sit in something very similar. And one of the things that I was going to look at was the interplay between this and how this would all work out. So I've done a lot with statistics, and then I realized PhDs don't make a ton of money. They like to be wrong. So I decided to not go down that route. But it's a long way of saying that when you look at statistics, it's so important to understand what are the inputs. And if you look at the last 30 years out, your information recovery when you went out with these surveys was close to 70%, anywhere between 65% to 73% return on surveys. We're now at like 30%. So if you think about it, if you're essentially taking 70% of hard data and extrapolating an additional 30%, which means that you'll have error, but not a huge amount. Now you're essentially taking 30% of actual data and extrapolating 70% of that data. I mean, that is a huge margin for error when you just think about general statistics. So I think that it's really hard to look at this data. One of the things that I learned on long ago was the importance of the supply chain. One of the things that I created as a portfolio manager was what I call well to wheel, or thinking of things on a flat line, because I noticed that E&P investors or analysts never talk to the midstream guys. The midstream guys never talk to the refiners. And it's like, well, guys, if the refiners aren't buying crude because they're cutting runs, then why are you bullish E&Ps that are increasing production? Like, just talk to the refining guy. So I think now you're starting to see this pivot, and you have to look at the supply chain. The supply chain is boats, so freight and trucks. Ships and trucks are going to show you what is happening in the world. That is where you need to look, because a boat is going to tell you where things are coming. Is there an increase in demand? Is there a decrease in demand? Is there something that's lumpy because people are only buying at specific times? I think that's where you can get the most insight now, and less looking at, okay, what is the data doing? I do think PPI is very good at giving you some of that leading indicator, but what comes before PPI? Freight. And that's where I like to look at, what are the ships doing? What are the ships cost? How many TEUs are on them? And what does that mean for PPI? And I think those input costs that you can see clicking, every second of every day, or I should say every second of, 6.5 days, you get an idea of what that price is going to be. And then with the AIS transponders, now being public record, you can then track how many boats are moving, where are they moving, is there an increase or decrease of them? And then I think FreightWaves does a great job of showing you, it's like, hey, there's a rejection rate of X. This isn't really good. It means that truckers are taking anything they're offered because they're just trying to keep their freight liners moving. And I think you can get a real feel for the economy by looking at that hard data, instead of, to your point, looking at some of this esoteric information that is going to be flawed just based on the surveys you're receiving.
Well, I believe there was a great pull ahead before Trump took power of the inbound freight and the threat of the coastal strike, the Atlantic longshoreman strike.
Yep.
And I believe that pull ahead is going to have a major impact on economic growth in the first half of 2025. Then the threat of Trump tariffs, which everyone got all hyped up and worked over about, not understanding that he uses it for negotiating tool. Now, in some cases, and I will apply this directly to South and Latin America, it is a valid concern because there's been a lot of transshipment from China through South and Latin America to the U.S. to bypass previous tariffs. In your opinion, and this is where I come in because I'm a transportation geek from where my history and work history, you sit there and look at this from the big picture. If you look at CSX, BNSF, Union Pacific, et cetera, their intermodal traffic has been in a slow sloping decline Is that not indicative of potentially a recessionary outcome for the first half of this year?
Absolutely. I think you have to look at rail immediately because as much as based on your background, you can appreciate, it's an oligopoly. So they can charge you whatever they want. But even though they have that ability, you'd much rather put 100 cargoes onto a train instead of 100 different trucks going across the continental U.S. So you're always going to push to put something on a rail car because overall it'll be cheaper. It may be less convenient, but realistically, you build that into your model, you have that factored into your inventorying and warehousing, and you're off to the races. So I think it all starts with intermodal. So the leading indicator, the very leading indicator, is that freight coming in. To your point, a lot of that was pulled through fear for tariffs. But then, okay, where does it go from there? And I think at this point, you're starting to see that shift away from that intermodal, and it's not showing up in trucking, which means that you're getting a gradual slowdown. Typically in recessions, and this is where I think sometimes people get it wrong, people will see a big spike in trucking, a big spike in intermodal, but realistically, Target, Kohl's, Dick's Sporting Goods, they still need inventory. So you're gonna buy stuff. You're just gonna buy it less frequently, and it could be lumpy because you're gonna let prices come down, and everybody's seeing the same screens. So you're gonna try to get and pick that bottom, and then you'll get a nice little spike, but spending has been put under pressure. People aren't buying as much, and then they'll slowly whittle down that inventory. So you get a lot of these false moves, which we've seen in November. We saw it again in February of last year, and then you saw it again in July, and it continued to kind of whittle down. I think you're going to see something similar. To your point, you're already starting to see those cracks, and the fact that the consumer is so over its skis, more so than ever before, it's going to be interesting to kind of weigh how do the Trump tax cuts, are they really going to be enough to give that little juice? But if they do, is it going to be something that is going to be very short-lived, like we saw during the COVID spending?
Well, that goes to the next point. We're going to phase into credit, which is one of my big subjects for this theme this year. And that is, I believe, in verify your opinion. That's all. We can't really sit there and say this is concrete yet until the data comes in, that there's going to be a limitation on quote unquote subprime or lower tier credit heading into this year due to the delinquency rates picking up, especially when you start reading Capital One and some of the banks that are coming in, and the potential for a lot of regional and community banks to fail, not just on the consumer side, but also the commercial real estate side.
Yeah, my biggest issue, and this is something that I if you go through my Twitter feed, you can see that I've been talking about this for God knows too long, is that the whole yield curve is going to shift up, but different parts of it are going to rise faster. And right now, I think we're in a duration risk. So you're going to start to see the bear steepener, where the long end of the curve is going to move up exponentially faster than the short duration side, because the short duration has already kind of had that move. You're going to want, the people are going to sit there and say, okay, I'm a retiree. I'm someone that maybe I'm 62, getting ready to retire. I don't know, 5.5% on a 2-year, not terrible. Are you willing to take that same risk at 5% for a 30-year? Probably not. And I think you're starting to see that shift, and that shift is going to accelerate. Not to say that the 2-year isn't going to continue to rise. It's just the 10-year, the 20-year, the 30-year is going to do it at a much faster clip as our balance sheet looks worse and worse. And I think that is the component that's going to weigh even more when you start looking at subprime, when you start looking at these different rating agencies and these different banks, because realistically, and this is why I always laughed at these these Fed stress tests. So it's like, okay, guys, you were so ignorant to the fact that rates could possibly go up. You thought you controlled the world, so you never stress test against rate hikes or rate increases ever. Because realistically, people got lulled into such, I don't know, comfort that their hedging strategies, their duration risk strategies just fell by the wayside. So all of a sudden you had a spike in rates and people were completely insolvent. Now that's just on the duration risk. That doesn't factor in the asset mark to market. So now you have, to your point on CRE, when you start looking at real estate, when you start looking at consumers that are increasingly delinquent on their credit cards, most people don't appreciate that most credit cards are carried by regional banks, small community banks that provide it for their local area. As those delinquencies increase, you can't, so, okay, a consumer goes bankrupt, they go into bankruptcy. Where are you on assets? So all of a sudden the consumer's struggling. So you have to increase your bad debt expense for the consumer. We continue to see commercial real estate that are going at fire sales, selling 60%, if not more, below last sale. So what did you write that debt on? Are you even collecting back your principal? And that's when I start to look at multiplier effect. And this is where the law of diminishing returns comes in. Not to bore anyone. So the law of diminishing returns just means that every time you issue something, you have to issue more of it to get the same amount of growth. So the first time you do it, $1 is $1 of growth. The second time you do it, $3 equals $1 of growth. And so on until it gets worse and worse and worse until you get to a point where you have now a negative util, which just means that every new incremental dollar of debt or spending actually has a negative impact. And if you look at our multiplier effect, which is measuring $1 invested should be $1.1. It means you're making 10 cents on every dollar. If you just look at the highway system, on average, for every dollar spent building the U.S. highway system yielded $3 of GDP growth. So now every dollar issued is yielding 87 cents. So you're not even covering principal, let alone interest. And that is where you're starting to see that really creep up, and you're seeing it in the subprime market. I think you're starting to see it elsewhere, and you look no further than where cars are. And I think cars are giving you the indication on where that market's going to bottom out.
So let's go to the big question. Some of the big questions here. Number one, I think the Fed has absolutely butchered the policy for the last 2 years. And I know. I read your Twitter, so it's like, yeah. This is a total foobar. For those of you who don't know what that means, Google it. Do you think Treasuries, once again, and the U.S. bond vigilantes will ride just like they did in the late 70s and early 80s during that last stagflation to correct the speculative excesses we've been witnessing?
Yes. One of my running jokes is, higher rates fixes this, because higher rates makes people do due diligence. When money is 1% and somebody promises you that they're going to be growing in 6 years' time, you're like, okay, well, I can sit here and wait. And a lot of this was in tech, where people could claim Metcalfe's law. Metcalfe's law is something that is based on every one new user increases to 3 users, which increases to 72 users. And it's what's been used. It's called Metcalfe's law, of explaining why Facebook took so long to get to 1 million users, but Instagram was that much faster. So they utilize these things. But then when you look at it, there was really no business plan to be cash flowing. And one of my favorite lines from Silicon Valley, not to pick on that again, but when the gentleman says, cash flow, you don't want cash flow. People can measure cash flow. That's something that they can use to look at what your valuation should be. You're always pre-cash flow. You're always pre-money. And I think that has to end. And that can only end if rates are higher, your cost of capital goes up, and you really have to factor in, where is my break even? When am I cash flowing? And what is my yield to the consumer? Because it's going to have to be something above the 10-year plus some risk adjustment. And I think that's what really needs to happen. To your point, Powell absolutely, and the Fed in general for the last 30 years has mucked it up. You know, one of the things where if you want to look at Powell and what he did in March of 2020, fine. You know what? You have the bazooka. That's what you're there for. I still don't know what data they were looking at that said we have to buy mortgage-backed securities. I know by me, people were looking to move out of the city. Houses that were for sale for 18 months were flying off the shelf. Mortgages were 2%. I was like, okay, why are we supporting this? Like, so if you didn't buy mortgage-backed securities and the banks could naturally just unload their risk, okay, so they'd be getting 4.5% mortgages. So why do you need to get them to 1.5%, 2%? I was like, clearly you're trying to just protect assets and create this wealth gap. And my favorite is when they sit there and say, oh, we need a working group to understand the wealth gap. It's like, guys, you're the ones creating the wealth gap. Just hold up a mirror and you know where the wealth gap is. People who have money and assets are going to be fine. People that don't have money and assets will not be fine. It's very simple. But they like to complicate it, and now they waited way too long to pull back on MBS. Now they decided to cut rates for reasons that made no sense. People try to say protect jobs, but okay, so we went from 3.7% unemployment to 4.2%, while if you just did basic math, the inflation was clearly going back up to 5%, and that's where I think they made the same errors as they made in 1978, and we're going to see that move higher, which to your point on the bond vigilantes, this is where it's going to get interesting. Now, not to belabor the point, but we have to talk about Japan and what's happening there, because we're integrally linked to what happens with the yen, to what happens with the BOJ. And realistically, based on the moves in their inflation, the moves there, they're going to have to increase rates at least another 50 basis points, as I predicted they were going to raise rates last night. So now you have a situation where the carry trade is going to come under pressure, and realistically, QE, quantitative easing, is going to die where it was born, which was Japan. And I think
I hate to interrupt you real quick,
Sure.
but do you think, as I do, and I haven't offered any writings or speculation on this other than the occasional X posting, that the Bank of Japan absolutely, pardon the French, effed up in a major way last night by not being more aggressive in addressing the inflation issue head on with a 50% rate increase?
100%.
0.5%.
Yes, 100%. They are continuing to hope upon hopium. Like they define hopium at this point. They would have been better suited to go after the 0.5% and hope that Trump gets his wish of pushing down our rates. Not to say that that's going to matter, but they need something to show that they're going to defend. The problem that they're going to face now is what happens if they have a failed bond auction, which is becoming ever more likely. And I think a failed bond auction, which is, if you want to call it black swan, but probably like the probability is only increasing, is going to become a huge overhang when you start looking at the Japanese markets. And the reason why I talk about that so importantly is because Japan was where this all started in 1998. You can talk about 1997, but the introduction of it was in 96. They deployed it in 98. And now if that happens, well, we've been doing QE not as long, but not too far off, just 10 years. So what happens to us? What happens to our auctions? Does all of a sudden we have a when issued that all of a sudden you're blowing not, 2 basis points through the tail, but you're blowing, 50, 100 basis points through the tail. That would be a huge shock to the system and really start that debt spiral only increasing, because then our interest expense are only going to go through the moon to the moon. And I think that's going to be a huge issue going forward.
Well, let's go to the big question, because I don't want to abuse our time with you. Mark, you have been absolutely fantastic as a guest, and I appreciate all of your insights. But I'm going to make a hard U-turn back to energy, because the big question I have for you, and since I'm the host, I get to ask it, is I see a problem, and this is my prediction personally, just analyzing what's happening in the transportation industry and consumer demand. And with Trump's drill, baby, drill, the Saudis suddenly having to get more product to market, Russia in desperation mode. Do you see WTI and Brent with a 50-ish handle and another attempt from the OPEC cartel, it'll fail, to kill U.S. shale again this year?
So I don't think you'll see them go after shale. I think when you look at the last time they did this in 14, don't get me wrong, shale, they wanted to slow, but the bigger focal point in 2014, or I should say November of 14, was to go after the amount of Iranian crude sitting on the sidelines that was going to get pushed into the market when Obama essentially took away the sanctions. So there was a push to take that capital away prior to and really fight for some sort of market share and try to set the tone. Realistically, at this point, there's really nothing that they can do, nor do they really want to do it, because light sweet is not a target for them, because they're getting such a premium in the medium and heavy side. And I think the bigger shock to the system is going to be the flip. And I actually think that we're much closer than further away, where heavy is going to trade at parity, if not a slight premium, to light. And I think that's going to be a bigger shock, which is something that is going to benefit them and really is not something that they're going to want to drive down. They'll just play nice and continue to price out the U.S. from buying medium heavy, providing optionality for the Asias. But one of the things as well, the Middle East since 2012, when I was working in Riyadh, was helping them redevelop or look at their structure. Why are you just selling oil when you could sit here, build refiners, build petrochemical, and go down the value chain and create a higher value hydrocarbon? So they've also spent a lot of money focusing on building their refining capacity. And the U.S. has taken a lot of time of shooting itself in the foot and shuttering a lot of our refining capacity. So now they hold a lot of the swing production when you look at diesel, when you look at gasoline. So they could say to Trump, sure, I'll do this, but you still have to buy my diesel because you don't have a refiner of meaningful size on the East Coast. So the Atlantic Basin is going to trade at a premium. The only refiner that we had of size in Philadelphia exploded in June of 19. So now what? So you have this shifting universe where I think refined products is going to show you kind of where the optionality is and where the market's really going to shift to.
Well, Mark, I don't want to take too much time, but Six wants to join us real quick, who's one of our MacroEdge team. He has a question for you, but I just want to say, please promote C6 Capital, your website, your X/Twitter username, everything you want to sit there and push people forward to understand the information you provide and everything you can sit there and keep the average investor, which is the majority of our audience, along with institutional investors, aware of what's happening.
Sure, I appreciate the opportunity, and then I'll happily take the question. So my Twitter handle is @MarkFNY. I'm always happy to engage in DMs, just on the main thread, answering anything and everything. I've fortunately or unfortunately have traded or invested in everything from private equity on down to derivatives and everything in between. Right now, the website is c6capitalholdings.com. We are a private equity firm that is currently in fundraising mode. We have circled a significant amount of capital. We need our anchor. That anchor allows us to go out and buy about 190 megawatts that we have hard circled and negotiated across 3 different distinct locations of the Northeast, Midwest, and Southeast. When I was working with GE, I was able to see moisture content going back about 1,000 years. There's never been a simultaneous drought across those 3 locations. So we are diversified not only in topography and geography, but also pricing structure and price drivers, which is, I think, the best optionality. And we're buying things that are operating. They're cash flowing. The moment we buy them, they cash flow into our account. We're vertically integrated with generating capacity, operators. We have our own maintenance crews as well as fab shops. So we bring down the cost, and we provide insights on a monthly basis where we talk about kind of what's happening. I'm happy if you want to reach out. My email is M Rossano at c6capitalholdings.com. I can send you reports that we've done where I outline the carry trade, everything down to the process of getting connected into the grid and everything in between. And we're currently running a Soltec A round where we're raising money to build several facilities for Soltec. And we're actually doing an SPV, a special purpose vehicle, to build renewable diesel. I think biodiesel is ridiculous. I want things that are molecularly identical to petroleum diesel. Back to the comment on not having any refiners on the East Coast, I think that there's a huge opportunity to convert that wood and biomass into a renewable diesel product that is cost competitive to the petroleum world.
Well, Mark, before 6 hit a bad sell, and he apologizes for that, so he couldn't answer the question. But I will tell you this. I would appreciate if you'd contact Governor DeSantis and tell him to put a refinery in Florida. It's the one thing we're lacking and would provide our state with energy independence, especially if we put it in north central Florida, away from the hurricane impact zones, and more so to sit there and supply our state independent of other states, because we get everything by barge now, as you know, from Louisiana. You have been fantastic as a guest and informed and educated everybody. And thank you once again.
I appreciate the time. Thank you so much.
Mark, you have a great evening. Folks, for MacroEdge Radio, this is John Galt speaking. We will be back next week, live 4 p.m. Friday, January 31st, where things are about to get spicy as the Fed speaks next Wednesday. And God knows what that crazy SOB does to the market. Good night now.